From a single shop in Sichuan 3 decades ago to China's #1 hotpot brand, that's Haidilao. The brand's edge is a tech-enabled operating system, smart scheduling, supply chain discipline, and tightly engineered kitchen guest flow, paired with an exceptional service experience. You don't just eat hotpot here, you feel looked after. In this video, we'll break down Haidilao's business model, translate it into the key financial drivers, and discuss the company's current valuation. From a single shop in Sichuan 3 decades ago, Haidilao scaled nationwide and listed in Hong Kong in 2018 as Haidilao International Holding. During COVID, rolling lockdowns and dine-in bans forced temporary restaurant closures across China and pushed table turns down before recovery. The next turning point was December 2022, when the overseas business was carved out and listed separately as Superhigh International via a distribution in specie. From that date, Superhigh's results are treated as discontinued operations of the group. For this video, we are analyzing Haidilao International only, not Superhigh. So if you are an investor, make sure you are looking at the right ticker. Haidilao stands out for standardized hotpot wrapped in a high-touch service layer, a moat the company itself frames as 3 pillars: service, product atmosphere, and technology. The experience often begins before you sit it. Many stores set up a waiting area with free snacks, and at select times, some outlets offer complimentary manicure or hand care. Once at the table, the theater takes over, most famously the hand-pulled noodle dance, and in some locations, a brief face-changing performance. None of this is guaranteed, availability varies by store and hour, but the playbook is repeatable enough that guests come to expect a little show alongside the meal. The food model is simple and customizable. Shared soup bases, fresh add-ins, and a sauce bar that flexes to local tastes by city. Technology stitches the experience together. Guests join digital waitlist in the app, get nudges when their table's ready, and order on tablets tied to the membership system. In the background, real-time dashboards help managers balance queue length, prep, and staffing. That combo, tight SOPs plus light spectacle, pushes table turns without making the service feel rushed, which is the engine of unit economics. Beyond dine-in, Haidilao extends the brand in 2 directions. First, off-premise, delivery and take-home kits that let regulars run a mini hotpot at home. Second, commerce, an at-home line, the Haidilao Mall, that sells soup bases, condiments, and small SKUs to keep the relationship alive between visits. Around the flagship, the group is also testing multi-brand concepts under its pomegranate umbrella. Formats like barbecue and regional cuisines to add growth without diluting the core. It counted 11 brands at end 2024 and 14 brands, 126 restaurants by June 2025. The result is a system built for consistency at scale, reliable food, visible hospitality, and process discipline, with tech as connective tissue so the brand can outperform in a fragmented market while gradually widening its revenue base. Quick data note: the charts that follow use group totals for 2015-2021, including the overseas restaurants later spun off as Superhigh International. The overseas contribution in those years was relatively small, so trends remain representative of the core China business. Revenue climbs from about 5.8 billion RMB in 2015 to 42.8 billion RMB in 2024, roughly a 7.4x increase, which works out to an impressive 25% CAGR over 9 years. EV to revenue jumped to 9x in 2020 on reopening hype and hypergrowth. Today, it's 1.36x, an attractive level assuming execution holds. In H1 2025, revenue for Haidilao International was 20.7 billion RMB, minus 3.7% year-on-year. About 90% of revenue came from core restaurants, with 10% from adjacencies, delivery plus newer brands, and small retail franchise lines. The decline was mainly throughput-driven. Table turns and guests' visits eased amid intensified competition. Aside from the change in store count, which we'll examine later, revenue has two levers: table turns, throughput, and average spend per guest, ticket. Turns rose into 2019, collapsed with COVID overexpansion, bottomed in 2022, and by 2024 are roughly back to 2015 levels. Recent softness is mostly competition consumption, not pricing. Average spend is almost flat over a decade, plus 7%. Pricing is kept accessible, promos are used, and a greater lower-tier city mix pulls the blended ticket down. Raw material and consumables costs are one of Haidilao's biggest swing factors, and the cleanest place to see their impact is the gross margin. Over the last decade, gross margin stepped up from the mid-15s to 59% in 2016. Recorded raw material costs fell after tax purchasing changes. Drifted down in 2019-2021 as the ingredient costs share rose and the menu was upgraded. Then rebounded to a decade high, 62% in 2024, on lower purchase prices and tighter procurement. EBITDA margin goes one step further. It's after most day-to-day costs: staff, rent, utilities, promos, HQ, but before depreciation, amortization. So it shows operating efficiency and throughput, not just ingredient costs. EBITDA margin sits around 20% in normal times. The low start in 2015, 14%, reflect early scale economics. There wasn't much operating leverage yet. In 2020-2021, the margin collapsed to 4% in 2021 as COVID controls and an over-rapid rollout crushed throughput, and the group incurred closure optimization costs. Outside those shocks, Haidilao has returned to roughly 20 to 22% in 2023-2024 as table turns normalized. All that operating efficiency shows up in earnings. On the EPS chart, we go from 0.06 RMB in 2015 to 0.87 RMB in 2024, about a 35% CAGR, faster than revenue's 25%, even though the share base edged up 16% over the decade. The dip and 2021 loss sit right in the middle. Then, EPS rebounds as stable turns and margins recover. H1 2025 EPS was 0.32 RMB versus 0.38 RMB in H1 2024, a 15.8% year-on-year decline, mainly as stable turns and guest visits softened amid tougher competition and shifting consumption. We have covered price per guest and table turns. The third lever is store count. The network surged over the last decade but has been flat since 2021, slipping in Tier 1, Tier 2, which points to saturation for the flagship format. Over 10 years, the average ticket per guest barely moved, but that's partly a COVID effect. Absent major shocks, I expect roughly 3% annual ticket growth over the long run as inflation is passed through without hurting traffic. On adjacencies, pomegranate brands, online at-home SKUs, delivery, selective franchising, I'd assume a conservative 1% contribution to annual growth. Profitability by brand isn't broken out yet, and at-home consumption could slightly substitute for some dine-in occasions. Net-net, I see 4% long-run revenue growth for the China business, driven mainly by steady ticket normalization and small option-like adjacencies. Haidilao still runs the vast majority of its restaurants. Franchising began in 2024 and reached 14 units by June 2025, still a tiny share of the network and revenue. The business is asset-light. PP per share has fallen since 2020 as depreciation exceeded additions and some sites were closed, sold, reclassified. The market cap to tangible equity ratio is back near historical lows for Haidilao, yet it still looks high for a brand and lease-heavy restaurant model. Debt stepped up in 2020-2021 to cushion COVID and found the build-out capped by a $600 million 2.15% note issued in early 2021. Since 2022, they have bought back part of that note and rebuilt cash, so leverage faded and the group returned to net cash. Capex peaked in 2020 at 6.1 billion RMB, 21% of revenue, during hyper-expansions, was cut sharply in 2022-2023 and edged back to 1.3 billion RMB, 3% in 2024, signaling a shift from build-out to maintenance optimization. Free cash flow swung from negative during the 2018-2021 build-out COVID years to solidly positive from 2022 as capex was cut, peaking in 2023 and still strong in 2024. At today's price, that's roughly 10x price to free cash flow on 2024 numbers, attractive if capex discipline and traffic hold. At 12.8 Hong Kong dollar, using the financial year 2024 final EPS plus the 2025 interim, the indicated dividend yield is approximately 6.6%. That comes with a very high payout ratio, 90 to 95% in 2023-2024, which necessarily constrains reinvestment and limits future growth optionality. The stock is back near the low end of its post-IPO range. Early on the market, priced in hypergrowth. Now it's pricing a mature, slower model. At 12.8 Hong Kong dollar, the shares trade at 13.5x financial year 2024 PE. Using H1 2025, TTM is approximately 14.4x. On return math, if the 6.6% dividend yield proves durable and long-term run EPS growth about 4% and the multiple stays flat, a simple yield plus growth heuristic implies 10 to 11% expected annual return. Haidilao is a scaled, service-led hotpot brand that has moved from hypergrowth to a steadier, execution-driven phase. Its strengths are clear. A repeatable service moat backed by technology and tight operating discipline, solid cash generation from a throughput-focused model, and a brand with enough recognition and membership gravity to hold traffic. On top of that, the company has real but measured optionality in delivery, at-home SKUs, and the pomegranate spin-outs. The flip side is just as real. The China footprint looks close to saturated, especially in Tier 1 and Tier 2. Average spend per guest has barely budged over a decade. Table turns are naturally capped, and the very high payout ratio limits reinvestment and reduces strategic flexibility. If earnings compound at about 4% a year and the multiple stays flat, that points to roughly 10% annualized total return from here. Reasonable for a defensive restaurant name and one that can have a place in a diversified portfolio. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share. If you are after a higher growth story, check out my video on Guizhou Maotai, the world's largest alcohol company by market cap.